Ever looked at your crypto wallet and wondered, what if the tax man could see this? Well, guess what? In many cases they can, and they actually do. In today's video, we'll explore everything you need to know about crypto taxes and regulations in the UK, India, and the USA. We'll also discuss strategies to legally minimize your crypto taxes. Is crypto taxable? So many viewers are curious about, is crypto taxable? I hate to break it to you, but the short answer is yes. When you sell or trade crypto that has increased in value, you make a capital gain. Think of it like selling a house. If you buy a house for $100,000 and sell it for $150,000, you've made a capital gain of $50,000. The same principle applies to crypto. If you buy Bitcoin for $10,000 and sell it for $15,000, you've made a capital gain of $5,000. This gain is taxable. And if you're mining crypto, any coins you earn are considered income and are subject to income tax. The amount of tax you pay depends on your overall income for the year. Crypto tax regulations in different countries. In most countries, there's something called a tax-free allowance. This means you can earn a certain amount of capital gains tax-free each year. Like in the UK, crypto assets are considered a form of property, which means they are subject to capital gains tax. You can earn up to £12,300 in capital gains without having to pay any tax. Anything above this amount is taxable. For the 2023-2024 financial year, the tax-free allowance for capital gains has been cut to £6,000, and it halved again in April 2024 to £3,000. So, if you're a crypto investor in the UK, it's important to keep these changes in mind. In USA, the IRS treats crypto as property, much like UK. This means it's subject to capital gains tax. However, the tax rate can vary depending on how long you've held the crypto and your overall income. Short-term capital gains, for assets held less than a year, are taxed at your income tax rate, ranging from 10% to 37%. Long-term capital gains, for assets held more than a year, are taxed at a rate of 0% to 20%. In India, the situation is a bit different. The Indian government has proposed a 30% tax on crypto income, which is significantly higher than the tax on other forms of income. I mean, this has sparked a lot of debate in the country, and it's a hot topic we'll be keeping an eye on. In addition to the capital gains tax, Indian traders buying or selling crypto will have to pay a 1% tax deducted at source, TDS. So, if you're trading crypto in India, make sure you're aware of these regulations. Legally avoid crypto taxes. Alright, so we've talked about how crypto is taxable and the different tax regulations in the UK, India, and the USA. But now, let's discuss something that I'm sure you're all eager to know: how to legally avoid crypto taxes. Let me just clarify something important here. There's a big difference between tax evasion, which is illegal, and tax avoidance, which is perfectly legal. Tax evasion involves breaking the law to avoid paying taxes, while tax avoidance involves using legal means to reduce your tax liability. Today, we're only going to talk about tax avoidance. After all, we're not outlaws, are we? One strategy to minimize your crypto taxes is to buy and hold. This is one of the simplest and most common investment strategies out there, and it applies to crypto just as much as it does to stocks or even real estate. The idea behind buy and hold is pretty straightforward. You buy a cryptocurrency and hold on to it for a long period of time, regardless of market fluctuations. The goal is to ride out short-term market volatility in hopes of long-term gains. In most countries, you're only taxed when you sell or trade your crypto. This means that as long as you're holding on to your crypto, you're not triggering any taxable events. So, by buying and holding, you're essentially deferring your tax liability. Let's say you bought one Bitcoin for $10,000. Over the course of a year, the value of that Bitcoin increases to $20,000. If you sell at this point, you'd have a capital gain of $10,000, which would be subject to tax. But wait, if you hold on to your Bitcoin, you won't owe any taxes on those gains until you decide to sell. Another strategy is tax loss harvesting. This might sound like something a farmer would do, but it's actually a savvy tax strategy used by investors. It involves selling your crypto that has experienced a loss to offset the capital gains made from other investments. By doing this, you can simply reduce your overall taxable income. Let's say you have two cryptocurrencies, Bitcoin and Ethereum. You bought one Bitcoin for $10,000 and 10 Ethereum for $200 each. Over the course of a year, the value of Bitcoin increases to $20,000, while the value of Ethereum drops to $100 each. If you sell your Bitcoin now, you'd have a capital gain of $10,000. But if you also sell your Ethereum, you'd have a capital loss of $1,000. This loss can be used to offset your capital gain from Bitcoin, reducing your taxable income to $9,000. Interesting, isn't it? Now, both of these strategies are applicable to UK, India, and USA. There are another two strategies especially for USA. So, Americans, you've heard of an IRA, right? It stands for Individual Retirement Account, and it's a type of savings account that offers tax advantages for retirement savings in the US. But there's a twist to this tale. Enter the crypto IRA. This is like your regular IRA, but with a dash of crypto magic. It's a self-directed IRA that allows you to invest in cryptocurrencies. Now, why would you want to do that? Well, the answer lies in the tax benefits. With a traditional IRA, your contributions are tax deductible. This means you can deduct the amount you contribute to your IRA from your income, reducing your taxable income for the year. Plus, your investments grow tax-deferred until you start making withdrawals in retirement. So, if you're investing in crypto through a crypto IRA, you're essentially reducing your current tax liability while betting on the future of crypto. In UK, the concept of a crypto IRA doesn't exist in the same way as it does in the USA. They have a similar concept known as a self-invested personal pension, but it currently does not allow for direct investment in cryptocurrencies. Another strategy for Americans is to set up a charitable remainder trust, or just CRT in short. This is a type of irrevocable trust that allows you to reduce your taxable income by donating crypto and receiving a return on the donation. It's pretty simple. When you set up a CRT, you transfer your crypto into the trust, and then the trust sells the crypto and pays you an income stream for a certain period of time. At the end of that period, the remaining assets go to a charity of your choice. And the best part is, because the trust is tax exempt, it doesn't have to pay capital gains tax when it sells the crypto. This means more money for you and the charity. Plus, you get a tax deduction for the charitable donation. It's kind of a win-win situation. You reduce your taxes and support a good cause. Who knew taxes could feel so rewarding? The UK uses other forms of charitable giving, such as gift aid. In India, the concept of a CRT does not exist in the same way as it does in the USA and UK. But India has various provisions for charitable giving under the Income Tax Act. You can also consider gifting crypto to friends or family. In many countries, gifts are not considered taxable income for the recipient. This means that if you gift your crypto to someone else, they won't have to pay any tax on it. However, there's a limit on how much you can gift tax-free each year. In the US, you can gift up to $15,000 per person per year without having to pay any gift tax. If you're married, you and your spouse can each gift $15,000 for a total of $30,000 per person per year. Anything above this amount is subject to the gift tax. In India, gifting crypto is considered a transfer of assets. If the value of the gift exceeds 50,000 Indian rupees, it is taxable in the hands of the recipient. Sadly, in the UK, gifting crypto is considered a disposal of assets and could be subject to capital gains tax. Interestingly, for Americans, there's the drastic option of leaving the United States. While it might sound like a plot from a Hollywood movie, and we don't recommend this, it's worth noting that some crypto investors have actually considered this option to avoid paying taxes. Renouncing your U.S. citizenship to avoid taxes is a serious decision that should not be taken lightly. It involves a lot more than just saying goodbye to Uncle Sam. You'll have to establish residency in another country, and you might have to pay an exit tax. And besides, who wants to give up their favorite local pizza joint just to save on taxes? And that's a wrap. So, what are your thoughts on crypto taxes? Do you have any other strategies to legally avoid crypto taxes? Drop your comments below. Before you go, don't forget to check out our recent video on Must Know. What are Bitcoin ETFs? Make sure you hit that subscribe button and press the bell icon. Thanks for watching.